Most short-term rental hosts are overpaying on taxes every single year, sometimes by tens of thousands of dollars. But don't worry, because we're going to solve that today. I'm breaking down the most important tax strategies for short-term rental investors and how you're able to get these type of tax savings even if you work a W-2 job and are just doing management on the side. We teamed up with CPA Amanda Hahn and the experts at Hospitable to give you this free short-term rental tax guide and go over all the specifics you need to save your money and not send it to Uncle Sam. Let's get into it. Hi, my name is Garrett Brown and I'm a short-term rental investor and the BiggerPockets short-term rental expert, here to talk about something most people never want to talk about, and that is taxes. It is tax season right now, and if you were like me a few years ago, I hated this time of year. I was so stressed. I did not know where my money was going or if it was even coming back to me. And now I am not as stressed anymore because I started working with the right CPAs who have the knowledge of short-term rentals specifically in the real estate world. Our free BiggerPockets short-term rental tax guide with Hospitable and Amanda Hahn is available now for download. I'll put it in the description, but let's cover some of the main things you need to know to save your money at tax season. First, let's talk about why short-term rentals crush long-term rentals when it comes to tax advantages. With long-term rentals, most investors need to qualify to be a real estate professional. This is the only way you'll be able to get your rental losses against your active income, and that's a high bar to hit for most people. But with short-term rentals, you don't need to qualify as a real estate professional. You can meet the material participation rules, which I will cover shortly about how you do that, just to offset your W-2 taxes and your active income with your short-term rental tax losses. That is some serious tax savings right there. And the crazy part about it is you can work a full-time job and still self-manage your short-term rentals, and you don't have to be a full-time investor to have this ability. And before we dive deeper into this, what does the IRS even consider a short-term rental? It's pretty simple. A short-term rental is a property that the stays average less than 7 days. If you are going over the average stay of 7 days, you're probably going to be classified as a long-term rental by the IRS. One of Amanda's pro tips is if you're tipping the scales and you're around 8 or 9 day average, you're going to need to get a few 1 or 2 day stays in there before the end of the year so you can get under that 7 day stay average. This is going to save you thousands in taxes. But next up is, how does Airbnb and short-term rentals even report your income? It comes down to Schedule E or Schedule C. Schedule E is the standard for short-term rentals, and this is when you don't provide extras like daily cleanings, concierge services, meals, and other things like hotels typically accommodate. You want to be on a Schedule E because you don't have to pay that 15.3 self-employment tax, and you're also eligible for depreciation deductions. The passive losses can be limited, but if you meet the material participation rules, you'll be fine. Now, if you're running your short-term rental more like a business, like a hotel, have daily cleanings and concierge services and things like that, you'll need to report as a Schedule C. You'll have to pay that self-employment tax. You'll be able to have more deductions, but it's treated like an active business. The key takeaways from this is if you want to avoid self-employment tax, then file Schedule E and don't have too many services at your short-term rental. Are you drowning in spreadsheets and guessing your STR profits? Don't worry, I get it. I was too until I found Baseline. Baseline is an all-in-one banking and bookkeeping financial platform that was designed for short-term rental investors. Imagine, no more reconciliation or manual data entries. Baseline's banking and AI-powered bookkeeping instantly will categorize your income and expenses, buy each property for real-time cash flow that you can see. Baseline automates all the financial busy work so you don't have to, and you can just focus on what matters, getting more bookings and scaling your business. It's time to take control of your finances instead of them controlling you. Are you ready to automate and supercharge your cash flow? Click the link below for your exclusive $100 bonus. Now let's talk about the STR tax loophole, which isn't a loophole, it's written into the IRS tax code. This is how you can legally use your tax losses from STRs to offset your W-2 and active income. There are two main ways to qualify for material participation rules. The first is to work at least 100 hours in your short-term rental and work the most hours out of any single person. If your cleaner has 120 hours out there, you're going to need 121 just to be able to qualify in this capacity. The second way is to work at least 500 hours in your short-term rental over the year. So you'll need at least 10 hours over 50 weeks of the year to get into that. And the easiest way to do this is to self-manage your properties. If you have a property manager and a cleaning team and a handy person, it's going to be hard to get that many hours inside. And I always recommend self-managing, especially for your first few rentals. You can track these different things by using an Excel spreadsheet, for example, and track your hours each week and also put them onto your calendar. I recommend not going back at the end of the year and just filling in a bunch of hours. Try to do this at least once a week to fill in how many hours you actually worked. And this will be much easier at the end of the year when it comes preparation time with your CPA. So how does this material participation rule even matter to you? Well, this is how you'll qualify for those STR tax losses that reduce your taxable income. Let's give you an example. We have an STR owner named Rachel. Rachel makes about $150,000 per year at her W-2 job. She has one short-term rental and it earns about $35,000 per year in revenue with about $12,000 in expenses and $40,000 in depreciation she's taken. Her net tax loss is going to be around $17,000, which she can use against her W-2 income, and this will bring her tax bill down by thousands. This is how smart STR investors reduce their tax bill legally and also work a job at the same time. But the real secret sauce is looking into cost segregation studies and bonus depreciation. We did have a talk recently with Sean Graham, who is a CPA and cost segregation expert, and I will link it below in the description, that he talks further about this process and how exactly to do it. And we're going to see this year if 100% bonus depreciation comes back, because that will be a game changer for short-term rental hosts. Basically, how a cost segregation study works is most depreciable assets are depreciated on a 27.5 year basis. Working with a correct firm that knows how to analyze each part of your property minus the land, because it's not depreciable, they'll be able to analyze for, between $1,000 and maybe $3,000 or, a little less here and there, what part of your property they can accelerate the depreciation on to capture in year one. Now, if you're going to sell your property soon, I don't recommend this because you're going to have to pay that back. And Sean talks about that a good bit. But if you plan on holding your property for a while, bonus depreciation might be a smart move for you in the first year. Talking with your CPA to understand if it's the good move will be crucial. So I'll give you an example. David, he's a short-term rental owner. He bought a cabin in the Smoky Mountains for $450,000, let's say. A cost segregation study allows him to deduct almost $70,000 against his W-2 income because he did bonus depreciation up front for these. That's getting real money back that you can reinvest into your properties then. BiggerPockets does have a CPA finder that you can use to find a real estate investing CPA, specifically one with short-term rental experience. That's where I got mine from, and they have saved me more dollars than I could have imagined this year. Even though they are pricey, the better ones are pricey. Take it from me, somebody who went cheap and had to pay a couple times to have my taxes amended or fixed, and I didn't even get the money back that I was expecting. Working with somebody that actually is qualified is going to cost a little more, but you're going to get that money back, and they're going to be well worth what they are paid. One of the key things about this video to take away, though, is if you self-manage your properties, it will be very easy to qualify for the material participation rules. That's where something like Hospitable comes in hand, because you'll be able to automate guest messages, automate cleaning schedules, all these things that seem so daunting to a short-term rental owner or a long-term rental investor that's thinking about coming into the short-term world. Using a tool like Hospitable is going to make your time so much easier. You'll still have to spend some time on the actual STR operation, but it will be on things you enjoy or bringing in more revenue. All these automated things you can do, you don't need to be spending your time doing those. Hospitable can handle it for you. They also will be able to show you where your income is coming in. They have QuickBooks integration, so your CPA and bookkeeper will be able to track everything very easily, and it's a deduction on your tax expenses at the end of the year using this type of software. Short-term rentals offer some of the best real estate tax advantages out there, if not the best in my opinion, but it's only if you use them correctly. Remember, we do have the free short-term rental tax guide in the link below. Please download it. Let us know if you have any questions. Subscribe if you made it all the way to the end and you appreciate this type of content. And I think YouTube wants you to watch one of these videos right here. I'll see y'all next time. Take care.